4 big mistakes your CPA is probably making on your taxes and why it's costing you a ton of money. Every year, I review hundreds of tax returns prepared by other CPAs because that is the first step of tax planning. So mistakes from missed opportunities to lost deductions, those are things that unfortunately I see way too often. So today I'm going to share some of the most common tax mistakes that are made by CPAs who work with real estate investors. All right, the first mistake we see all the time is depreciation not being optimized. Depreciation is basically a paper write-off. The tax law says when you invest in a rental property, the building will have wear and tear as time goes on. And because there is an expectation that there's wear and tear, then we as investors get to take depreciation or write-off on the purchase price of that property over time. What's really important to understand is that depreciation is not just limited to the down payment that we make to the property, it's actually based on the purchase price of the building itself. Whether you bought a property with 20% down or no money down, depreciation is going to be the same in both instances because it's just based on the purchase price of that specific property. And also depreciation is a benefit we can get regardless of whether the property is actually going up or down in value. So what we typically see is you'll invest in the rental property, it's actually going to appreciate in value from the market, but for tax purposes, we take a depreciation write-off year after year. What we love about depreciation is that not only do we get to take that paper write-off, but we have so much flexibility in terms of how and when we do it. For example, if I have a property with depreciation, I can choose to slow it down, meaning I'll take it slow and steady over the next 27 years. Or I can choose to speed it up with things like cost segregation. I can accelerate as much as legally possible into this year so I get a huge tax savings or tax refund in this specific year. If we made a mistake on depreciation, we can actually catch it up, or we can file amended returns to correct for those as well. So as you can see, depreciation is not only a tax benefit, but it's also a very flexible one, which makes it one of the most coveted tax benefits to real estate investor. But here's the problem. What I typically see when I review tax returns is depreciation not being calculated correctly. What I mean by that is not taking into consideration what the land value is of a property. For most properties, we're purchasing it not just the building, we also own the underlying land. Often see that missed on a depreciation, which could be detrimental because in the future when you sell that same property, so you might accidentally be paying too much taxes if we forgot that there was land associated in your purchase price. Another thing I see missed all the time on depreciation itself is CPAs who missed out on all of the purchase cost and loan cost. As we all know, when we buy a rental property, we're not just buying it for the purchase price amount. There are a lot of costs associated with that property. Closing costs, prorated property taxes and fees, and if you have a loan on it, there are loan costs as well. So very, very frequently, I would say more often than not, those loan costs and purchase costs are missed from the depreciation schedule. The best way to avoid this is when you buy a rental property, don't just tell your CPA the property address and how much you bought it for. Actually send them the closing statement and ask them to pick all of those expenses from the closing statement so that you don't miss out on those tax benefits. In addition to not having the right depreciation amount for the calculation, something else that we see missed all the time is depreciation not being optimized by itself. And a big percentage of tax returns we review are missing accelerated depreciation. In fact, we recently had a new client who had a handful of rental properties where there was no accelerated depreciation done on any of them. And when we asked their tax preparer why that was, they just said, well, sure, I guess we can do it going forward. Although that is correct, we can still catch up for that mistake going forward. It was a lot of missed opportunity in the past. The other mistake that I see very often are missed tax deductions. Now, we all know as property owners, we can write off our mortgage interest, property taxes, insurance, management fee. But what I most often see missed are some of these overhead expenses with respect to real estate education, real estate membership, travel for real estate education. And on top of that, car expenses and home office deduction. Some of the pillar tax deductible items are the ones that I actually see missed quite a bit. Here's a common scenario too, that after I noticed these missed things, I would ask the client why they didn't claim those. And often people will say, well, I don't know. I thought I've been claiming it this whole time because I do provide all that information to my tax preparer. And so if you don't know how to review your own tax return to verify whether those things on there, here's a tip that you can use. When you meet with your tax person, how much did my home office save me on last year's taxes? How much did my trip for Bigger Pockets or the real estate conference, how much did that save me in taxes last year? That way you are forcing them to tell you whether it's deducted and having them quantify the actual tax savings. A big tax mistake that we see for real estate CPAs is not using the short-term rental tax loophole. In case you don't know what that is, short-term rental basically allows someone to have a full-time job still outside of real estate, invest in Airbnbs as a side hustle, and potentially be able to use those losses to offset income from their W-2 earnings. And if there's someone who's married, they can also do the same to offset taxes from their spouse as well. A lot of times tax preparers confuse that with long-term rental properties, or not understanding that Airbnbs are different than regular traditional long-term rentals. And what I often hear is somebody's CPA telling them that in order for you to use the short-term rental tax loophole, you or your spouse have to be a real estate professional, basically quit working and do real estate full-time. And that is absolutely incorrect. The reason it is called the short-term rental loophole is because you don't actually have to be a real estate professional. As long as you meet material participation hours, you can then use short-term rental losses to offset all types of income, which includes W-2s, retirement income, gain on sale of your stocks or cryptos. The options are pretty endless. So how do you know if you're a victim to this bad tax preparer? Here's what you do. If you invest in Airbnbs and your tax person tells you, oh, you can't use the benefit because you need to be a real estate professional, that's your sign that you're not working with the right person. Because when you invest in Airbnbs, real estate professional is a non-issue. We don't even talk about it because it's irrelevant. What is relevant is that you meet material participation hours. And if those are new to you, you can check out my other YouTube videos where I go in depth into what exactly the short-term rental tax loophole. All right, another huge tax mistake that we see in the majority of tax returns that we review is missing out on the business entity tax break. This came out a couple years ago where there was a new benefit that says if you have taxable income in your entity, let's say LLC, partnership, or S corporation, the entity could potentially pay your state income taxes and take that as a business deduction. Versus traditionally, personal state income taxes are personal expenses and not a business write-off. So effectively, this entity tax break allows you to have the entity pay for your personal state taxes to turn that personal expense into a legitimate business deduction. The majority of states now allow for this tax benefit. However, when we review tax returns, I would have to say the majority of accountants are not taking full advantage of this. And this could be very, very significant. If you have a property management company where you have $100,000 of income for that year, paying $10,000 in state taxes through your entity provides you with a $10,000 tax deduction that you were otherwise not able to get if you were paying for that personally. So, tip time. How do you know if you are using this tax benefit correctly? You can ask your tax preparer whether you are using the pass-through entity tax break. Hopefully, they'll be able to tell you whether you are or not. Another way that you can look for yourself is to look at whether you are paying state quarterly estimated taxes personally, or if those are being paid by your business account. But nonetheless, the best way is to simply ask your tax person whether you're using the pass-through entity tax break to your advantage. All right, there you have it. 4 very common tax mistakes that we see made by CPAs nationwide as it relates to real estate. Unfortunately, we can't always just assume that our advisors know everything there is to know about real estate tax benefits. We work so hard for our money, whether it's through our jobs or through real estate investing, and really important to not always just focus on making money, but also dedicate some energy to making sure that you're saving the money that you made as well, because taxes saved could be the easiest money you ever made. If you like this video, please be sure to hit the like button and subscribe to get more tax saving strategies. And of course, if you know anyone who is overpaying in taxes, be sure to share this with your friends.